All right, welcome everybody. My name is Greg Cohen. I am super excited that you're here with us on the webinar today. We're going to be talking about build to rent investments. And if some of you are like, what the heck is a build to rent investment? You're in the right place. If you are familiar with it and you want to understand the specifics about how it can boost your cash flows and make for a very profitable rental property portfolio, you're in the right place. And we're going to jump right into it today. So I'm going to share my screen here. We're going to kick this thing off and away we go here. So with that, I'm going to kick it off talking a little bit about, and before I forget, if you do want to connect with me in a little bit more of a personal way, you can find me on Facebook, facebook.com/cashflowproperties. I'm there. I'm always available, always commenting, always doing things. So find us there. But here's a little bit about me. My name is Greg Cohen. I am from a company called JWB Real Estate Capital that I have been blessed to be with from the very beginning. I am a co-founder and absolutely love what I do. I own over 300 rental properties. So that's important because the concepts that I'm going to be sharing with you today all come from real world experience here in Jacksonville, Florida. That's where I invest. We do serve over 1,000 clients. We manage over 3,200 homes. So we have extensive experience. And all in all, JWB manages over $350 million in real estate assets. And in order to do all of this, we do have a full-time team of over 80 employees here in Jacksonville. If you're a local in Jacksonville, would love for you to come by, check us out. If you're not local here in Jacksonville, there's a lot that you can read about JWB. So knock yourselves out. Now, today, I'm going to be talking specifically about build to rent. But before we get in there, I want to tell you a little about my story. All right, so my story from a real estate investing perspective started back in 2006. I was actually just leaving a job that I despised. It was in corporate America. I used to work for a company called Johnson & Johnson. Fantastic company. But I can tell you that my situation there wasn't great. And so I remember being sort of depressed and not really understanding where I wanted to take my career from that point. I had just graduated college and I'd been working there for about 1.5 years, and I thought that corporate America was the right route for me. And I remember in a moment where I was not feeling very good about my career path, a friend of mine gave me a special book called Rich Dad, Poor Dad. And for any of you out there who are on this webinar and you're shaking your head, it's because Rich Dad, Poor Dad has had a positive influence in your life as well. It is an incredible book, and it helped me understand what my career passion was going to be. And that became real estate. Now, the problem is I didn't exactly know which part of real estate I was going to go. And so I have 3 business partners. And in the beginning, it was like the wild, wild west for us. Now, there are a million different ways that you can make money in real estate. And I think we tried all million of them in the beginning, just trying to survive. I mean, at that time, I was a 23-year-old kid with very little experience, no experience in real estate, very little experience in the real world. So the odds were stacked against us. This was also 2006 when the market was on fire. And so some of the things that we did in 2006 turned out to be profitable. And I remember saying to myself and my business partners, dudes, we're pretty good at this. This is going to be great. We would send out properties. We would send them out by email. We would have those things sold, and I thought we were pretty darn good at what we were doing. Well, then 2007 happened, 2008, 2009 happened, and I think we all know what happened in terms of the real estate market there. So that was a tough time for my business partners and I. We were faced with a decision whether to run from real estate, as many did, or the decision was to invest further and deeper and to really refine what were we good at versus what were we not good at. I'm telling you, this was a very difficult time in my life. At one point, we had lost over $1 million, and we were only halfway through the year. All right, and I had no clue what $1 million really looked like at that point. I was borrowed to the hilt, and I had a lot of friends and family's money that I had borrowed, and I was losing a lot of money. It was a very, very difficult time in my life. But what it did is it forced me and my business partners to look at what we were doing and see what was working and what wasn't working. And so as I was looking at this $1 million loss halfway through the year, I looked at it and I wanted to see what activities were leading to that. And as I looked, all the activities when it came to buying and flipping, and it came to the activities of wholesaling, and it came to the activities of lease options and seller financing and subject to, and all these creative strategies, those were the ones that were losing millions of dollars for me in a market where prices had fallen and buyers were scarce. But I also looked at something else that I was doing. See, all of this first year and a half, I wasn't just buying and flipping. I was buying my future retirement portfolio, and that was rental properties. So my business partners and I bought cash flowing rental properties. We bought about 40 rental properties in about a year and a half. And so, but we never spent a whole lot of time on this, right? It was just something we did. We thought, well, we're going to hold on to this for 20 years or 30 years. That'll be our retirement. But we didn't spend a whole lot of time. And I remember the epiphany that we had as we were so down and so depressed looking at our business, looking at the $1 million hole we had dug for ourselves, and the revelation understanding that all the activities that we were spending 90+% of our time was the things that we weren't very good at. We were marginal at best. All the flipping, all the creative strategies, right? The things that we were really great at, the thing that was working for us even in a down market was rental properties. And we were spending very little time on it. You see, because as the rental market, as the real estate market pricing dropped, rents stayed consistent. So my cash flows on those 40 rental properties stayed consistent. And it was like this light bulb went off for my business partners and I. And we said, this is what we're great at. This is the intersection of what we're passionate about and what we're built to do. And from that point, we have focused on turnkey rental properties for ourselves and for clients just like you. And so that's really what JWB is all about. We have packaged a turnkey rental property experience where folks can buy a rental property from us. But what they do is they do it much differently than the old-fashioned way. They actually come to us. They have a pile of money that isn't working for them in some other asset class. Maybe it's the stock market. And they want to put it into rental properties. And they come to us, and we already have new construction homes built. They already have a tenant in place. The management is done by us in-house, already in place. And they're able to buy these homes as an income stream. So this is what came from that very terrible experience for me of losing over $1 million, but now has served us. And now we're going into our 14th year. We serve over 1,000 clients, as I mentioned, and it's something that we absolutely love to do. And if you would like to learn a little bit more about investing in rental properties with JWB, go here. It's jwbdemo.com. You can go there at any time. What you'll be able to do is sign up for a demonstration with my team. We can show you what it's like to be a JWB client. You're going to really love that. The other thing is, if you do have questions on the webinar today, feel free to fire those in. I'm going to do my very best to answer those on our webinar today. And if not, I'm going to make sure that we get back to you very, very soon there. So you can also get those questions answered on the demo. Either way, it's up to you, but make sure you take advantage of this opportunity here. So today, when we talk about build to rent, we're going to talk about what the heck is build to rent, right? We're going to talk about the market forces that have allowed for build to rent to happen over the last 8+ years or so, why you should be considering investing in build to rent, and the future of build to rent. All right. So let's take a little bit of a step back. Let's assume that somebody doesn't know what build to rent is, right? When I speak of build to rent, it's the idea that somebody builds a new construction home for you and then puts a tenant in there for the purposes of you collecting income and creating an income stream for you. And it's a passive investment for you. Now, the alternative has always been renovations, right? People for a century now, or damn near close to it, have been buying undervalued rental properties and then putting work into them and then renting them out and hoping to make positive cash flow. Well, wouldn't it make sense if you had a brand new construction home to do the same thing, except now things probably aren't going to break as much and your tenant's really going to love where they live, right? So that's the concept of build to rent. You can actually build a portfolio of rental properties now that are brand new construction. And this is the hot topic right now in the turnkey rental property space. So we're going to take a look at the market forces that have allowed this to happen. I'm going to take you guys on a little bit of a timeline here so you can see where this has come from and then where it's going. So let's go back to 2007. Okay, what I'm showing you here is the Jacksonville median home price, actually from 2001 all the way to 2012, so that you can get some perspective here. But what happened in 2007, right? Home prices started to crater, and they dropped 35% by the time it became 2011, right? Now, part of the reason why nobody had done build to rent prior to this was because home prices were so expensive. Land prices were so expensive. And the cost of materials and labor to build those houses was too expensive that you couldn't make the cash flow numbers work. So it was just never done, right? But now what we're seeing by this chart, and all of us probably know this, right? Home prices fell dramatically. So that means that home prices fall, land prices are at an all-time low or very, very low, and that might create the possibility of build to rent. But just because land prices fell didn't mean that that was going to make it good enough for us to be able to make the numbers work from a positive cash flow perspective, right? We had to have this perfect storm of labor and materials of building construction come down as well. And what I'm showing you here is a chart of US housing starts from 1950 to 2019, and this chart's in the thousands here. So when you see that 1,000 level there on the right-hand side, it's actually 1 million starts, right? So from 1950 all the way to 2006, sort of, we had over 1 million starts, or very near almost every single year we had over 1 million starts. And then when the housing market fell, the demand for housing fell, prices fell, builders weren't going to be building anymore. They were running away, right? Builders were in trouble. There were only 554,000 houses started in 2009. That's the lowest on record since the Great Depression. That is a big deal. Do you think it was easy to find home builders who were hungry for work at that point? Absolutely. Do you think the cost of materials was very low at that point? Absolutely. Just to put this in perspective, every year in the US, we create about 1.5 million households, right? So if only 554,000 were built in 2009, that at that point helped to have the glut of houses that were built prior to it, helped to drop that. But you can see now that we haven't even reached that 1.5 million households built as of 2019. So things have been creeping up. But again, going back to 2009, housing prices had cratered. Home builds, housing starts had also cratered. It created this perfect storm, which became the build to rent phenomenon. So in 2011, the birth of build to rent happened, and the birth of build to rent happened here with JWB, which is really cool. So in 2011, JWB in Jacksonville, Florida, built 30 homes for rental. This was the first time that homes had been built for the purpose of renting them out, and we built 30 of them, and that's where we were right there. That's the 30 homes. We found a builder who was in trouble, who couldn't build on the home lots that they wanted because they couldn't sell it to owner occupants. And we said, I bet we could get that land cheap enough. And I bet with our connections, we could find a builder to build it cheap enough because they're starving for work, that we could be into this house for the same cost that we would be into a house that we renovated. And it just started to create this idea in our head that, man, if we could accomplish that, this would be so much of a better asset for an investor, for a turnkey investor, right? Because your tenant's going to stay longer, your house isn't going to break as fast because it's brand new. And we're like, I bet this thing has legs. And guess what? It did. So these are a couple of pictures of our first ever build to rent homes that we built. Some of the first in the country are right here. And that was 2011 here in Jacksonville. In 2013, the Wall Street Journal found out about us. Isn't it funny how you hear of this overnight sensation that's been working for a decade and building build to rent homes for 2 years at this point? But that was the Wall Street Journal for us. It was one of the biggest and coolest things that we had accomplished up to that point, to be featured on the front page of the Wall Street Journal. And they were featuring this concept that I'm sharing with you, this build to rent strategy. And here's a few excerpts from the article, right? It was called New Homes Get Built with Renters in Mind. JWB Real Estate Capital was on the leading edge of a national trend. The Wall Street Journal takes a look at that dynamic today, and it outlines Safakis' strategy. Alex Safakis is my business partner, and our strategy was buying land at an extreme discount, so we're still able to rent it for a profit. This was a game changer. I remember I got a phone call from my father-in-law at that time. He had just randomly picked up the Wall Street Journal and was reading this article, and he said he was so excited about this article that he was going to tell me about it, and then he found out that it was about us, which was a really cool experience. So this is what we've done since 2011. We've built over 560 new homes since 2011. What you're seeing here is the footprint of our new construction here in Jacksonville, Florida. All of those little blue marks are all of the brand new construction homes that we've built for clients and that we currently manage. Right? Have you ever played this game Risk? Right? I think we all pretty much know that board game. I love this. We have this visual of all the homes that we have under management here in Jacksonville, and it's all these little dots, and I feel like we're slowly but surely taking over Jacksonville. This is the 562 brand new construction homes. It gets even more fun when we talk about all the homes we have under management, which is over 3,200. But this is really exciting for us. What we have seen in our business is that new construction has been proven as that model here. But I'll tell you, we're a relatively small part of the equation when it comes to the potential for what build to rent could be, right? But let's take a look at what this has meant for our business, okay? So I've taken you now from 2011 as we continue to ramp up, but we quickly found that this was such a wonderful investment for our clients that we have dedicated more and more resources to building new construction homes every single year. In 2017, we started 180 brand new construction homes. 2018, we started 270. 2019, 375. And looking forward to 2020, we're planning for 400 new builds to be started just in 1 year. That'll put us on the top 10 list of builders here in Jacksonville for sure. Now, what does this mean to inventory for you? If you're somebody who's interested in investing with JWB, that means that you're probably going to see a brand new construction home when you come on board, and then we start to build your portfolio. Over 75% of JWB's properties are now new construction, which is wonderful. And we're going to talk about just about how wonderful it is in this section here. Why is it so wonderful? Why should you invest in build to rent? Well, I'm going to share a story with you of two of my absolutely favorite clients, Matt and Alicia. All right, Matt and Alicia got married not too long ago. They came to us in 2016, and a young couple, very successful. Matt is an organic grain broker in Arkansas. And I remember my first conversations with Matt when we were putting his portfolio together, when I was mapping out his plan for him. I said, Matt, why are you so attracted to the Jacksonville market? Why are you so attracted to investing with JWB? And he said, I know that there's other markets out there that have positive cash flow and yada, yada, yada. He said, but here's what I want. I want an asset that is going to have positive cash flow today. And I want long-term growth potential. I want consistency today. I don't want to go cash flow negative today. I want consistency today, but I want the most potential long-term growth. And that is the perfect mentality if you're thinking about investing in Jacksonville. As I shared with Matt when he came on board, I said, if all you're looking for is the most potential cash flow, new construction in a growth market like Jacksonville is probably not going to get it for you, which was kind of surprising. All right, a lot of people are surprised when I say that. But if all you're looking for is the most cash flow, you should go to a market like Cleveland or Kansas City or one of those really low-priced markets. And you'll get a little bit more cash flow than you will in Jacksonville. But what you'll also be giving up is long-term growth potential, and you won't get build to rent. So Matt was completely on board. He loved the idea of something that is going to have a long-term growth effect, because when you look at your overall return on investment, especially if it's a finance portfolio, if you look at a market where things are appreciating 4% a year and you put 25% down, that type of appreciation for your returns skyrockets. It's actually 4 times it if you only put 25% down. So he looked at this and he said, listen, I'm willing to give up a few extra bucks of cash flow somewhere else to put my money in a market where things cash flow for me, meaning that they pay for themselves every single month, but I might have twice the potential for long-term growth. And that's why Matt loved Jacksonville. Matt also loves golf, which I love golf. And so these were some pictures from his honeymoon. Topgolf was, oh, that was another big reason why Matt loved Jacksonville. I forgot to mention this. Matt loves Topgolf. And when I mentioned that there's a Topgolf in Jacksonville, Matt was like, all right, dude, I'm in. Let's do this. So thank you, Topgolf. Now, what have Matt and Alicia done since then? Matt and Alicia completely bought into our mentality of how to build a successful portfolio. So the first thing we do with every client when we bring them on board is we map out what we're going to accomplish. So Matt and Alicia knew many years in the future, 3, 4, 5, 10 years in the future, how their portfolio was going to look. And they knew how much capital they needed to bring to it in order to accomplish a certain income stream, right? We asked them, why are you investing? That's that first section here. And they said they want an early retirement. They wanted financial freedom. And I said, that's wonderful. Let's take it a step farther. Let's define what that means. Look at your expenses. Look at the income that you're going to need from this asset class. And together, mutually, we built this plan based on $11,000 a month of passive income coming in from their portfolio. And this is what we do with every client. So if that's of interest to you, sign up for that demo at jwbdemo.com. This is exactly what we do for clients. We then map it out one step farther and we say, okay, well, how many properties is that going to break up into? For Matt, it became 16 properties. And then, of course, Matt has fulfilled his plan year after year. He and Alicia are now at property number 15. They are one away from that plan and an incredible success story. And here's what it looks like for Matt and Alicia's portfolio. Brand new construction, right? You probably weren't expecting this when you thought of rental properties or rental property portfolio. But this is what Matt envisioned. Cash flow pays for itself every single month, potential for long-term growth. And this is what it looks like. So how have they done? Okay. Now we track every bit of returns for our clients. So Matt and Alicia get this report on a monthly basis. They've been with us just about 4 years now. Their lifetime return on investment is 10.72%. They have put over $198,000 of net rental income into their bank account. Their total return is over $323,000. Now you may be asking, what is the difference between net rental income and total return? Net rental income, you can think about what hits your bank account every single month. So the rental income minus your principal, your interest, your taxes, your insurance, your property management fees, everything that's net to your bank account. But there's a lot of other advantages to take into account when calculating your returns. Tax savings is a big one that people don't think about, right? So taxes are a big potential profit center. Tax savings are a big potential profit center. It's why people go to rental properties, why your CPA is probably telling you to buy rental properties as to reduce your tax burden. And principal pay down is another part of this. Your tenant is paying the rent, paying your mortgage for you. And if you total all that up, the returns, as you can see here, get even better. But here's where I want you to focus, because if you're thinking about investing and you want to get consistency, right? This is what consistency looks like. Here is every single year for Matt's 15 properties and what the return on investment has come out to. The lowest it's come out to is 10.25%, and in the first year it was 11.88% to get to an annualized lifetime return of 10.72. Now keep in mind here that next column, we always share, what did we tell you we were going to do? What did we tell you to expect from a return on investment perspective? And his was a little bit over 8%. Do you think Matt's a happy camper? Do you think Matt and Alicia are pretty stoked? Absolutely. And it's a credit to them. They made a wonderful decision and they understood the mentality that was going to serve them well to help them get to this financial freedom. And they're well on their way. One thing to take into account again here, one thing I have not talked about yet, hopefully you picked up on it, is property appreciation. Property appreciation is not factored anywhere in those returns that you're seeing on the screen at the moment. Should be pretty exciting for you. That is just an extra bonus on top. That's how we think of it. So put yourself back in the shoes of Matt. Okay, so Matt is looking for consistency with cash flows, paying for itself. And then once he achieves that, he goes into long-term growth potential, right? So the number one reason why Matt should have been looking at new construction rental properties, and why you should look at new construction rental properties as well, is lower maintenance costs. And again, this should make a lot of sense. It's a brand new house, comes with builder warranties in place, and things don't break nearly as often, right? So you're going to see lower maintenance costs. Now, in the industry, you're going to want to sort of know what your expectation should be for maintenance costs. And there's a formula to it. So your maintenance cost percentage is your annual maintenance cost divided by your annual potential rental income. Annual maintenance cost over potential rental income. That's your maintenance cost percentage. And for the industry standard, you're going to find that 7% is about what the industry standard is, and you're going to see that reflected on a lot of turnkey providers or real estate investment spreadsheets, right? 7% for maintenance costs. And what it's looking at is the percentage of maintenance costs over your rent. Well, here's what we find for new construction maintenance costs. And again, this is data compiled from all JWB client-owned new construction properties, over 560 of them since 2011. Maintenance costs at 4%. If that doesn't get you fired up, you might be in the wrong webinar. I'm telling you, if you can reduce maintenance costs, you're going to put the smile on the face of a rental property investor. Is it harder to find positive cash flow today than it was a few years ago? Absolutely. For any of us who have been trying to find rental properties, what you're seeing is there's incredible competition out there. Prices are going up. And what happens there is it makes it harder to find cash flows to you. So dropping from 7% maintenance cost to 4% maintenance cost is a big deal. What it actually equates to is over $400 a year of additional positive cash flow. And I'm telling you, and you probably know this as well, that $400 a year might be the difference between a bad deal or a good deal. Or it might be the difference between your investment, putting a smile on your face after you've already made it, or causing stress in your life. Right? This assumes a monthly rental income of $1,150, which is very typical for a Jacksonville investment property. So reason number two, and it's really linked with the first reason, is lower vacancy costs, right? If you have a better home living situation, a new construction house, your tenant is going to want to stay there a lot longer. And there's, of course, a formula for this as well. It's called vacancy cost percentage. And what you're looking at is your annual lost rent due to vacancy over your annual potential rental income. Lost rent over annual potential rental income is vacancy cost percentage. And your industry standard is about 5%. Now for JWB, as we have tracked this again for every new construction rental property, we have been able to prove a 2% vacancy cost. Not 5% like the industry average is, real numbers, 2%. Equates to over $400 in additional positive cash flow, which equates to over $800 of positive cash flow additional each year. And beyond that, the single greatest pain point for an investor out there is maintenance costs and vacancy costs. So even beyond the numbers, you are going to be so happy if you don't have these $800 of maintenance costs coming in each year. You're going to be even more excited about your rental property portfolio. Here's how our new construction performance has shaken out since 2011. As I mentioned, we track every dollar in and every dollar out for our clients. We report this on a monthly basis. Matt and Alicia see it, and here's how it's shaken out. $93 million of assets, 562 rental properties sold, brand new construction. The expected returns that we shared with those clients was 6.8%, and the actual return on investment has been 8.4%. I also want to highlight, again, only rental income and expenses, does not take into account home price appreciation. That is just gravy. That is just a bonus on top. So let's talk a little bit about long-term appreciation. Does build to rent, does new construction rental properties help with long-term appreciation? You bet it does, okay? The average appreciation rate across the US from 1991 to 2018 was 3.75% from the Federal Reserve economic data there. Now, I took a section of it from 2011 to 2016 because the data was available. And across the US, average appreciation was 6.3%. We were in a great market for real estate from 2011 to 2016. Things were going up. So well above the historical average, but 6.3% is across the entire country. So then what we did is we broke it up by open floor plan or two-car garages in this case. These are features that brand new construction homes have. And what you see is that even that accelerated home price appreciation rate of 6.3%, even though that was high, homes that have characteristics of brand new construction, like open floor plans, appreciated at a rate of 7.4%. Two-car garages still appreciated more than the national average during that same time period. So if you have assets that have an open floor plan and a two-car garage, you're more likely to see increased home price appreciation than the average, which happens to be what we have for brand new construction homes. Now, do you think Matt and Alicia benefited from some of that gravy on top, some of that additional benefit from home price appreciation that isn't factored anywhere into their returns? You bet it. They started to invest in 2016, right? Right here on the map, that's what you see on the graph, right? Of course, home values have continued to go up since that point. Now, you may be saying to yourself, well, they just hit it right. They just, got to the point where they got a whole bunch of appreciation. And the reality is that Matt and Alicia are investing for the long haul. Their plan is to own these properties through retirement. And so that's why our investors don't care about home price appreciation in the short run as much as they do the long run, right? The long run generally tends to repeat itself from a home price appreciation perspective. And in Jacksonville, you'll find that home price appreciation averages a little over 4.3%. But you got to be invested for the long haul. And they are. So yeah, so they've had a great run, higher than average appreciation in the short run here. But it's not like they're selling. It's not like they're selling out, right? I've had this discussion with them. I'm going to say, guys, listen, sometimes growth is going to be stagnant. You might even see it come down a little bit. It may go up like this. But after we talk for 10, 20 years, like we do, you're going to see that you're going to average right around 4.3% appreciation. And that's what is so exciting to them. So if you would like to put yourself in the shoes of Matt and Alicia and have this same type of experience as far as mapping out how this would look over the next few years, over the next 5, 10, 20 years, this is something that we offer for clients. It's our client demo. And what you're able to do is to walk a day in the life of what it feels like to be a client like Matt and Alicia. And we actually help you build this plan. We do it free of charge. And you can go and sign up for it at jwbdemo.com. Certainly encourage you to do that. So now by this point, hopefully we can all see where Build to Rent started, the genesis of it here in one of our neighborhoods in Jacksonville. We see why it makes sense. Where's it going, right? Build to Rent was not a thing when I started to invest in 2006. Is it going to continue to be a thing? Well, the thing that I will tell you is whenever you're trying to think about where something is going in the future, you want to follow the money, right? You want to follow the dollar bills. You want to follow the institutions, right? The big players are going to tell you how solid and proven a model it is. And JWB, well, we're a big fish in a small pond, right? I'm talking about the big fish in the big ponds, right? So let's see what they're doing. I'm going to take you on a milestone timeline as well. I'm going to take you back again from their perspective and the money that they started to put into it. So in 2011, hedge funds started to acquire and renovate properties, right? They saw the same thing that we saw in 2011, that prices were low. And they formed these home rental companies, very similar to what JWB does. And they were acquiring and renovating these properties. Now, they saw an industry that was fragmented and largely run by mom and pop investors. And they thought that they had an opportunity to professionalize the industry and make a ton of money. So over the next 6 years, they invested over $36 billion with a B, billion dollars in over 200,000 rental homes in the US. Following the money tells you that they really believed in it. Now, this was the first time in history that Wall Street was backing home rental companies that were formed for the purpose of acquiring, renovating, renting, and delivering a return on single family homes. Prior to this, it's typically done in the commercial space, in the multifamily space. So this was a big deal and is still a big deal. But again, they saw what we saw, right? Home values had come down. They saw this as a buying opportunity, and they saw this huge amount of inventory out there, and they said, this is the time to create a new asset class. And Wall Street was all in. 2013, they started going public. American Homes for Rent was the first company to go public and to do an IPO. Now, their response was tepid at best. It was not great. So what they did is they backed off a little bit from their acquiring, and they focused on operational efficiencies, because at this point they had bought hundreds of thousands of homes. This was their first time and they had no clue how to actually operate. And they focused on those operational efficiencies around that time. Here's some of the news articles that happened, right? American Homes for Rent prices IPO at $16 a share. Soon after, American Homes for Rent falls 2.5% after their IPO, right? It was not the best response. Fast forward to 2015 to 2017, you've got consolidation happening now. You've got these big players that are starting to gobble up some of the smaller players, consolidate in the effort to increase their returns for their shareholders. Now, there are two players that own 60% of the rental home market across the US. 60%. Invitation Homes and American Homes for Rent. They have focused on achieving operational efficiencies, and also part of the reason they were so excited about this back in 2011 is that they expected rents to rise, which they have. Here are some of the major players in 2015. It was Colony American, Starwood, Progress Residential, BLT. You may have known or heard or seen some of these names in the headlines. All of them got gobbled up and now became part of two that control. Now, it's not only two companies out there, but these two control 60% of the marketplace. At the same time, we saw things changing as far as rental demand. So home ownership rates at an all-time low, 63%. It's down from 69% in 2005. And that is a big drop, and that's just increased rental demand. But here is some of the most telling news. So it was a big deal when you had Wall Street jumping in to form these home rental companies. And it was a big deal when they went IPO and went public, right? Now, here's another iteration that proves the model out, okay? Builders typically build new construction homes and do what with them? They sell them. They sell them to owner occupants. Builders, generally speaking, historically, do not build new construction homes and hold on to them for rentals, okay? But that was the old way. Now they are. Builders are now building new construction rental properties and holding on to it because they believe in the model as well. 2017, there were 37 homes that were built by builders and held onto for the purposes of renting out, doing their own build to rent. That number jumped up 16% in 2018, year over year, 43,000 homes. Now, that's not a huge number of homes, to be honest, but this is the first time it's ever been done, okay? And this doesn't count all of the homes that they built and have sold to other home rental companies or investors out there. It's not included in this metric. This is the first time, and it's growing. It's something to pay attention to. 2018 comes, and American Homes for Rent is the darling of real estate. Excuse me, is the darling of Wall Street when it comes to real estate. Their shares are now up over 40% from the time that they went IPO. Big money is flowing to single families. Some of the big names that I know you know, Morgan Stanley, BlackRock, are increasing their holdings in the companies like American Homes for Rent because they believe in it as well. Invitation Homes spends over $200 million in the first 9 months of 2018. They've got a whole lot of money and they're searching for more assets. That is what is going on, which leads us back to build to rent. So you've got existing inventory as we stand here in 2019 that is scarce. right? You know it. You've read the headlines. You've probably experienced it. It is hard to find inventory to make the numbers work. Prices are rising. It's challenging on inventory to acquire it, and even when you acquire it, it's a slimmer deal. Got to come up with new ways to accomplish and feed the demand from Wall Street. And you've not only had this proven out from single family rental companies, but now builders are getting into it, right? Even more proven. You'll see some big names like Toll Brothers, Lennar investing millions in build to rent partnerships and holdings for themselves. Here are some of the headlines. Build to rent housing market explodes as investors rush in. Toll Brothers, others turn to build to rent. Taylor Morrison is the latest big home builder to bet on single family homes. Build to rent still booming. So here's what we know. It's a proven model. There is a tremendous amount of money right now that is searching for single family rental inventory, and inventory is scarce. Acquiring and renovating is tough sledding right now to meet hundreds of millions of dollars of demand. New construction has proven to be lower maintenance and vacancy costs, so it's better for the end investor, which is why all these Wall Street guys and all these home builders are jumping in now, right? Institutions and home builders are jumping in. Do you think it's here to stay? I think it's here to stay. And you know what? This slide, it says it's here to stay. So there you go. It's officially here to stay. No, build to rent is here to stay, right? There's money behind it. The assets have been proven. Wall Street's all in. Home builders are slowly becoming in. And it just makes sense. I mean, I can tell you from 2011, our clients are extremely happy with new construction. It's one of those things that you don't need to sell it, right? It's just like, it just makes sense if you're going to be investing in rental properties. So I hope this made sense for you. I hope you enjoyed this little journey through the build to rent phenomenon, seeing exactly why it works for clients today, lowering maintenance costs, lowering vacancy costs, and where it's going to go. So if you're an investor already and you have rental properties in your portfolio, get educated on build to rent. It is a huge opportunity for you now, and the returns you get today are probably the best you're going to get for a while because there's more and more demand coming there, right? And here is the best way to take advantage of it. You want to sign up for a demo. If you have any interest in investing with JWB, this is the way to take the first step. If you're interested in build to rent, if you're interested in the Jacksonville market, this is where you go. What we do is we build out a plan for you, just like we did with Matt and Alicia. We understand what's really driving your motivations, whether that's financial freedom or investing for your kids or doing it for charity or whatever it is. We want to know. Then we want to break that down into a monthly passive income number with you so you have clarity about what this is really going to take. We want to break it down into a number of properties, and we want to put you on a plan to help you accomplish that. That's what we do for all of our clients out there. So if this is of interest to you, I would highly recommend you go right here, jwbdemo.com. And again, you can find me on Facebook. I'm very active, facebook.com/cashflowproperties. I'm Greg Cohen with JWB Real Estate Capital. I hope you enjoyed yourself, and we'll talk to you very soon here.